Hello, I'm Sandy Weaver with Weaver Financial. Let's do the numbers. In a nutshell, in the second quarter, bonds marked time and stocks roared ahead. Inflation trimmed again to 3% from last quarter's 5% level. The Federal Reserve increased short-term interest rates, but just once in the quarter, and again only by 1/4 of 1%. The zinger this time? Jobs remain healthy. For the year, U.S. large companies lunged upwards 17%, but U.S. small companies rose only 8%, and overseas stocks paralleled that at 9%. Bonds remain in positive territory, at least, but only at 2%. What's the good news? No new bank failures this quarter, just the 3 incidents in the first quarter. The Federal Reserve appears to be close to the top in raising interest rates. We're at 5 to 5.25% now. The economy, as evidenced by jobs, job openings, and labor market participation, appears robust. Inflation is mostly slithering down slowly and mostly in the right direction. Gross domestic product, GDP, grew by 2% in the first quarter. The Atlanta Federal Reserve's estimate of GDP for the second quarter is another 2%. Quite respectable given the surge in interest rates we've had. What's the bad news? The stock market seems driven by a handful of large tech companies responding to the hype surrounding AI, artificial intelligence, and its anticipated effect on all things in our lives. The top 8 companies in the S&P 500 Large Company Index have returned 85% this year, while the average stock in that index has returned 6%. What's in the neutral zone? Inflation hasn't been beaten out of the economy yet. Wages are going at 6% now, although inflation is way better than the 9% we had last year this time. At 3% annualized now, we are still above that 2% target we're used to over the last decade. Core inflation, a narrower measure, is 4.8%, still too high. Housing data on existing home sales seems to have leveled off, but are still down significantly from a year prior. Mortgage rates remain close to 7%. Geopolitical tensions? We become accustomed to a war in our world with Ukraine. NATO is holding. Russia's events are curiouser and curiouser. Our politicians are making the right overtures to put relations with China on a calmer front while protecting U.S. interests. The European Central Bank continues to hike their own interest rates. Their inflation is higher than ours. Japan is holding rates steady. China is cutting their interest rates to boost a flagging reopening after COVID there. Japan's stock market bested all others, while the U.S. and Europe pulled in above-average optimistic returns. What's ahead? The stock market is trading at 19 times forward earnings. That's above the average in the 16 to 22 range, so it's highly valued. Earnings from large U.S. companies are expected to drop 7% this quarter from last year's second quarter. Net income fell 3% last quarter, but accounting shenanigans brought that closer to zero. The annual prediction for 2023 earnings still remains at a positive 1%, pretty low. Yet most pros project earnings growth to slow in the second half, responding to the impact of the Federal Reserve's interest rate hikes. Borrowing money costs more. Experts say it's difficult to see how the stock market can retain its optimism without a pause or a pullback. But if the 400-plus companies in the S&P 500 index respond to the robust economy and bring along U.S. small companies, it's possible the market may steady on. Absent that broader participation for all companies, a frothy market from here, moving significantly higher, doesn't seem warranted. That might perhaps represent a danger signal for the Federal Reserve and for us investors. Where are we now? The bear market appears to be over technically, or is it? But more and more pros are favoring a soft landing scenario where the Fed keeps interest rates elevated, yet the economy doesn't tank into a severe recession. Perhaps higher for longer may be the appropriate slogan for interest rates. The U.S. economy appears to be handling it well enough for now, barring an unforeseen negative catalyst. Our portfolios are diversified over different asset classes. We've benefited from stocks so far from this year. Bonds have helped some, but mostly in the first quarter. As long-term investors, we wait to see if inflation continues to ease down to target without a hard slam on growth. Thank you for your interest. Please call or email if you want to dig in further. I'm glad to pass on my readings, podcasts, and the other sources.